2 days ago, the International Monetary Fund, the most powerful economic organization on the planet, issued a stark warning. They cut their global growth forecast and said the world is drifting toward what they called an adverse scenario. Their words, not mine. The IMF now expects global growth of 3.1% in 2026, a 0.2 percentage point downgrade from its January forecast. Global inflation is seen rising to 4.4% this year. The fund also outlined a more severe scenario where oil and natural gas prices spike 100 to 200% and stay elevated into 2027, which would amount to a close call for a global recession, defined as economic growth below 2%. This has happened only 4 times since 1980. A close call for a global recession. Let that land. Now, before you panic, I want to give you the full, honest picture. What's actually happening, what the realistic scenarios look like, and most importantly, the specific moves that protect your savings, your investments, and your household budget, no matter which direction this goes. To understand where we are today, you need to understand the full economic chain reaction that has been triggered by the Iran war, which began on February 28th, just 48 days ago. The 2026 Iran war, including the closure of the Strait of Hormuz, has led to what the International Energy Agency has characterized as the largest supply disruption in the history of the global oil market. The conflict has echoed the 1970s energy crisis through acute supply shortages, currency volatility, inflation, and heightened risks of stagflation and recession. Stagflation. That's the word economists are starting to whisper, and it's the one word the Federal Reserve fears most. Stagflation means simultaneously high inflation and low economic growth. It's the worst of both worlds. Prices going up while the economy slows down. And it's the scenario the Fed has almost no good tools to fight. If they raise rates to fight inflation, they risk crashing the economy. If they cut rates to stimulate growth, they risk accelerating inflation further. The most obvious economic obstacle is inflation. Prior to 2026, the expectation was that the Fed would continue lowering rates to support a slowing labor market. Job growth has been little changed over the past year. But persistent inflation would derail the Fed and possibly set off a negative chain of events through the year. Here's what has already happened to the US economy since February 28th. The Consumer Price Index jumped from 2.4% annual inflation in February to 3.3% in March, the largest single-month spike since June 2022. National average gas prices are at $4.10 per gallon, according to AAA. Real wages fell 0.6% in March as earnings failed to keep pace with surging prices. Consumer sentiment fell to its lowest level in years, and the IMF just cut its global growth forecast. Should the current ceasefire hold, inflationary impacts will wear off. If fighting resumes, however, the future becomes much murkier, threatening the fragile growth the economy has seen over the past 2 quarters. That's the key variable. Everything hinges on whether this conflict resolves or escalates further. Let me walk you through the 3 realistic scenarios for where the US economy goes from here, because your financial moves should depend on which scenario you think is most likely. Peace talks are ongoing. There are signals from both Washington and Tehran that a deal is still possible. Oil prices tumbled after the White House signaled that a second round of peace talks could take place. U.S. crude fell nearly 8% to $91.28 per barrel on that news. If a genuine ceasefire and deal takes hold in the next 2 to 4 weeks, oil could fall back towards $75 to $80 per barrel. Gas prices would ease toward $3.50 by summer. Inflation would retreat back toward 2.5 to 2.7% by Q3. The Fed could cut rates once in late 2026 as planned. The economy avoids recession. This is the market's base case hope. No deal, no major escalation either. The US naval blockade is fully implemented. The IMF is warning the world is drifting toward an adverse scenario where oil prices stay around $100 per barrel. In this scenario, inflation stays sticky in the 3 to 4% range through Q3. The Fed holds rates flat at 3.5 to 3.75% all year. Economic growth slows to around 1 to 1.5%. No recession, but the kind of slow, grinding squeeze on household budgets that makes everyday life feel like a recession, even if the technical definition isn't met. This is where we are today. The IMF's severe scenario involves oil and natural gas prices spiking 100 to 200% relative to January and staying at that level into 2027, which would amount to a close call for a global recession. This has happened only 4 times since 1980. A resumption of military strikes, a wider regional war, or an attack on Saudi Arabian oil infrastructure could all trigger this scenario. In this case, gas could hit $5 to $6 per gallon nationally. Inflation could reach 5 to 6%. The Fed would face an impossible choice. GDP growth could go negative. This is not the base case, but it is a real risk that serious economists are modeling for. The honest truth: nobody knows which scenario wins. The IMF doesn't know. The Fed doesn't know. The smartest financial minds on Wall Street are operating in genuinely unprecedented territory. What you can do is position your finances to survive any of the three. The Federal Reserve is at the absolute center of everything happening economically right now, and its next move directly affects your mortgage rate, your savings yield, your credit card APR, and your overall borrowing costs. The Federal Reserve is delaying, not canceling, any sort of additional cuts, pushing them into the back half or even later in the year. That means elevated borrowing costs for consumers will persist. The FOMC meets April 28th and 29th, less than 2 weeks from now. Based on everything we know today, the Fed will almost certainly hold rates steady at 3.5 to 3.75%. The question everyone is asking is, when does the first cut happen, and does the Iran situation push it further out? Here's what that means for you in plain English. Your mortgage rate is staying elevated. If you have an adjustable rate mortgage, don't count on relief before Q4 at the earliest. If you're thinking about buying a home, the environment of 6.5 to 7% rates is likely to persist at least through summer. Your high-yield savings account and CD rates are still excellent, but this window will not last forever. A 1-year CD at 4.5 to 5% is still readily available. Lock that in now before any eventual rate cut reduces yields. Your credit card APR is staying above 20%. If you carry a balance, this is a financial emergency that the Fed is not going to rescue you from anytime soon. The only solution is aggressive paydown. Your home equity line of credit, if you have one. The rate is floating with the Fed funds rate. No relief coming until the Fed moves. Minimize draws on it. Whether we head towards scenario A, B, or C, the financial moves I'm about to give you are the right ones in all 3 cases. These are not extreme moves. They are the fundamentals that the smartest financial advisors have been recommending for decades, turbocharged for the specific 2026 environment. Move 1. Build your emergency fund to 6 months of expenses in a high-yield account. This is the single most important financial move of 2026. Not investing more, not paying down the mortgage extra. 6 months of essential expenses, rent, utilities, groceries, medications, sitting in a high-yield savings account earning 4 to 5% APY. This is your buffer against job loss, unexpected medical bills, car repairs, or any economic shock. With IMF recession warnings in the headlines, this buffer is not optional. Move 2. Lock in a 12-month CD immediately. Online banks including Ally, Marcus by Goldman Sachs, and American Express National Bank are still offering 12-month CDs at 4.5 to 5.0% APY. If the Fed eventually cuts rates later this year, these yields will drop quickly. Lock your savings in now and let it earn guaranteed interest for a year, regardless of what happens to rates. Move 3. Pay down high-interest debt with laser focus. Rising oil prices reduce the purchasing power of American consumers. ABC News points to the risk of reduced investment and employment as new uncertainty is injected into the business environment. In a potential economic slowdown, the most dangerous thing on your personal balance sheet is high-interest debt. At 20% plus APR, a $5,000 credit card balance costs you $1,000 per year in interest alone. In a recession, that debt becomes even harder to service because income becomes less certain. Aggressively eliminate it now while you still have stable income and the economy is still technically growing. Move 4. Diversify your income before you need to. Companies will invest and hire less as uncertainty is injected into the business environment. Job security in a slowing economy becomes less predictable. The best time to develop a second income stream is before you need it, not after a layoff. Freelancing, consulting, a part-time gig, selling things online, even $500 per month of additional income fundamentally changes your financial resilience in a recession scenario. Move 5. Review your investment allocation for your age and timeline. If you are within 5 to 7 years of retirement, this is not the time to be 100% in stocks. A market correction in a recession scenario can take 2 to 4 years to fully recover. If you need those funds in 5 years, a 30 to 40% allocation to bonds, short-term treasuries, or CDs protects you from sequence of returns risk, the danger of a big market drop right before you need to start drawing down your savings. If you are more than 10 years from retirement, stay the course. History is clear that patient, diversified investors who don't panic during recessions recover fully and come out ahead. Don't sell everything into fear. Don't try to time the market. Move 6. Watch the April 28th to 29th FOMC meeting closely. The Fed's statement and press conference on April 29th will be one of the most important economic communications of the year. Listen for language around whether they're tilting toward more rate hikes, which would signal the Iran inflation shock is becoming entrenched, or holding steady with a bias toward eventual cuts. That language will tell you a lot about whether scenario A or B is winning. We will cover it live on this channel the moment the Fed speaks. Before I wrap up, I want to give you something the doom and gloom financial media is ignoring. JP Morgan CEO Jamie Dimon said that with consumers still earning and spending and businesses still healthy, the U.S. economy has several tailwinds, including increased fiscal stimulus, the benefits of deregulation, AI-driven capital investment, and the Fed's asset purchases. The U.S. consumer has been remarkably resilient. Job losses have not spiked. Credit card spending is up 9% year over year at JP Morgan, which signals people are still buying things, still living their lives, still functioning economically despite the inflation pressure. The banking system is healthy. Record profits at JP Morgan, Goldman Sachs beating expectations, strong capital ratios across the board. Though recession fears have grown since the fighting began, most economists think the war will have only modest effects on gross domestic product, maybe shaving off a few tenths of a percentage point overall. The IMF's warning is serious and should be taken seriously, but close call for a recession is not the same as recession is happening. The difference between those two outcomes is largely determined by whether the Iran conflict resolves in weeks or stretches into months. Protect your finances as if the bad scenario is possible. Live your life as if the resilient scenario is probable. That balance is what good financial planning looks like in genuinely uncertain times. Today's bottom line. The IMF cut global growth forecasts and warned of recession risk. 3 scenarios are in play: deal and recovery, stalemate and slow grind, or escalation and real recession risk. The Fed holds rates at the April 28 to 29 meeting. Your moves: 6-month emergency fund in a HYSA. Lock in a 12-month CD now. Destroy high-interest debt, diversify income, and review your investment allocation for your timeline. If you found today's analysis valuable, hit like and subscribe right now. We're here every single day giving you the financial clarity that matters. Drop a comment. Which scenario do you think plays out? A deal with Iran, a long stalemate, or something worse? I read every single comment and I'll respond. See you tomorrow.